All right, guys, we're live. So thanks for joining the weekly Zoom. And we're going to go through, Mike, today is what to look for in a multifamily, right?
That's correct.
Yeah, so we're going to go slightly off topic quick, just something that we're dealing with now, and the question comes up quite a bit. We're going to go slightly off topic and talk about taxes for a minute. We'll talk about taxes for a few minutes. I actually took my own personal K1 from a deal that I'm very minimally invested with to show you what a K1 looks like and the power of this whole tax thing and real estate all tied together. So let me see. So I'm just going to shoot through it with you quick. I'll give you a quick broad overview of how this whole thing, tax deductions, work when it comes to these multifamily investments. And then I'll show you a K1. Then I'll quickly go through what I look for in a deal when we're searching for deals. What's an immediate turn off for me? What's an immediate turn on for me? And kind of basically our day-to-day on how we look for deals. So, okay, this whole tax deduction thing when it comes to multifamily, and something I've noticed is when we're raising capital. Let me turn this off. Hold on one second. Sorry, guys. When I get emails, it's going to make this computer ding, and I will turn that off. Give me 1 second. Mute this. Okay. So when we're raising capital for these multifamily deals, I've been confronted with a lot of times that we're raising capital towards the end of a year. And some investors, some of the larger net worth people that understand what I'm about to tell you, they basically want to know if you're closing by the end of the year. If the answer is no, they pass. They're not interested in how good the deal is, how bad the deal is. They just want to make sure that we're able to get the deal closed by the end of the year and they could get their depreciation for that year. And I'll explain to you how that works and what actually makes these multifamily investments so interesting and why multifamily is separate from all of the commercial real estate. Multifamily is depreciated as residential real estate as opposed to industrial, retail, manufacturing, office is depreciated as commercial real estate. So multifamily kind of lays in the middle. So you're able to buy these very large deals, get the numbers up there, and still depreciate it like regular residential real estate. So it depreciates faster, which kind of makes sense. I mean, you know, these properties do get beat up. There's a lot of people that circulate in and out of them, so they don't last as long. You probably wouldn't see a multifamily building last as long as a retail space or as office space. So real estate is depreciated over a certain amount of time, depending on your tax structure, the way they lay it out. A lot of times multifamily is depreciated over a 28-year period. So 28 years, an asset goes from, an interesting part about real estate is an asset depreciates, but in real life appreciates. So if you own a business or you have equipment in your business, automobiles, trucks, your fleet, office equipment, computers, it all depreciates, but in real life, it's actually depreciating. It's worth less as time goes on, unless you have the rarest computer in the world that actually gains value as time goes on. For the most part, all that stuff is worth less at the end of the year than it was in the beginning of the year. Real estate depreciates, and certain things within the asset depreciate at different rates. So I could go into a cost seg study and we can get into a whole tax thing. I'll try to keep this tax thing quick, but it's important because we sent out K1s on one of our deals and one of our investors immediately came back and said, I thought you guys said this thing made money, but on this thing, it says it lost money. So it's an interesting fact. So the real estate depreciates when it actually appreciates in real life. When you get your K1 statement, which I'll bring up and I'll show you, it will usually show some level of a loss. So it will take into consideration what a property made, and it will knock off automatically what it depreciated at, and that's your net income at the end of the year. So if we close a property by the end of the year and we do something called accelerated depreciation, which is through a cost segregation study, you could actually get a very sizable write-off at the end of the year. At the end of the year, even if you invest in a property that's closing right before the end of the year and they're doing a cost seg study and they're depreciating an asset with a bonus depreciation, it's possible that you could invest $100,000 in a deal and at the end of the year get a $20,000 or $30,000 tax deduction straight up, right off your taxes. Any other money that you make passively, it will deduct any taxes due on that, and that deduction will carry forward. Something interesting to know is if you could, or your spouse could qualify as a real estate professional. So if you're doing whatever you do, you invest in our deal, your wife or husband is qualified as a real estate professional, that will spill over into your earned income. So that's when it really starts to get very interesting. You could take $100,000, invest it into one of our deals. We do an accelerated depreciation. So you would ask us that when you invest, hey, are you doing accelerated depreciation? Yes. At the end of that year, which could be a couple weeks after you close, you could get a 20 or 30% tax deduction right off your earned income. So if you were going to owe the government $100,000 at the end of that year, you would now owe them 80 or 70,000. Pretty interesting stuff. So, you know, you hear guys, super large investors that don't pay any taxes. This is part of the reason why they have a tremendous amount of depreciation counting against everything that they make. So let me show you what a K1 looks like, and then we'll go into what I.
Chris, can I ask you a quick question?
Go for it.
So you said the deduction is off of earned income, not off of the passive income. Is there a difference?
Yeah. So you make, I mean, most people make money two different ways. Either you earn it or you earn it. You either work for it and earn it, earned income, or you make it passively. So it's kind of, it is separated. So depending on how the money is earned is how it's classified and how it's taxed. So if you have passive, if you're not a real estate professional, you could only deduct passive income against passive income.
Okay.
So say you earn passive income a bunch of other places in your life, that gets put into one pile, and then the depreciation of all the assets that it's coming from count against just that pile.
Okay.
So there's a wall between earned income and passive income that the only way to break through that wall is to become a real estate professional. So whether it's you or a spouse that becomes a real estate professional, that wall is now broken down, and anything that is, and any loss through passive income now spills onto your earned income, and you can now knock that taxable, you can now knock that tax burden down.
Okay, got it.
Yeah, so your goal is to knock that wall down, and you do it by becoming a real estate professional. You or someone else, meaning your spouse. If you have a full-time job, so if you get paid 40 hours a week, if one of you get paid 40 hours a week through a W-2, it's extremely difficult to get real estate professional status and earn your 40 hours a week in your W-2. You can't do both. So if it's one of the, I heard it's one of the highest reasons to trigger an audit is to improperly check the box off of real estate professional status. The reason for it is, the reason that law is even there is if you own a business and you have things depreciating around you, so your computers, your office and chairs and everything else that's depreciating around you, you're able to count that against what you make. Real estate professionals earn their income through real estate. So it almost becomes an unfair position for them if they can't count their real estate depreciation against their income. So that's why only real estate professionals are allowed to count real estate depreciation against their earned income. So sometimes you could have a property that has fully depreciated. So you've owned it for, It's been in the family for 30 years and it has no more depreciation left. So all of the passive income is being taxed. You could buy another asset and that asset's depreciation could count against the other income because it's passive to passive. So the goal is to have as much depreciation as possible and knock that wall down so it spills onto earned income. And I like to say, well, I like to point out that you don't think Elena Cardone wants to be showing apartments, do
Right.
you? That's for a reason.
Yeah.
Let's
Okay, so
go
what
on
if,
camera once in a while and we show apartments.
yeah, so if we have more than one business, does that affect being a real estate professional?
Yeah, so the burden's on you to prove it, but if it doesn't make sense on your taxes, if it doesn't make sense how you would possibly humanly be able to, and the IRS, by the way, does not believe that you could work 80 hours a week. So the idea of having 2 full-time jobs does not work for them. And actually the law states you have to work more than, so if you have a 40-hour week job, essentially you'd have to work 41 hours a week in real estate. So you have to work more in real estate than you do
Okay,
your other earned income. So it would have to be more than double. So the law is 750 hours and more than your other income. So if you're working 40 hours, you'd have to work 41 hours at least in real estate. And the IRS will not believe you that you work 81 hours a week, although a lot of us do. Americans think that's impossible. Some Americans think that that's just impossible. Some people can't make it through their 40-hour week. So we're doing 80 to 100 easy. And I love it. I get mad when my day's over. All right, so I'll show you what a K1 looks like. So if you ever get a K1, you see a negative on it, you are not losing money. Screen share. Let's see if I could get it here. Okay, so this is the first page of a K1. 2022, this specific deal, I just blanked out my social and my EIN. I don't know why. I'm sure you guys aren't going to go open credit cards under my name, but so this specific deal, I have a small place in, 50,000 bucks. It basically shows that my $50,000 investment is now worth $44,000. That is because of depreciation. So I technically am able to write, just because I'm an investor in this deal, it has nothing to do with the money that it's bringing me. It has nothing to do with the earnings of the deal. This deal could make 10x in 1 year. This would still apply. This deal essentially lost $5,200 this year, even though in real life it lost nothing. So this deal will get me a direct $5,200 tax deduction just by being invested in it. And these numbers are small, right? This is just a $50,000 investment. And it shows me my percentage ownership in the deal. So I owe 2.9% of this deal. This is a deal that I'm a general partner on. So it's a small deal. We threw 50 grand at it each as investors. So we'll get depreciation on a general partnership side as well. And this will show actually. So this is, if you're a general partner, your checkbox will be here. This shows me as a limited partner. So when we as general partners invest in our deals, we go alongside the investors as our money in. So I am whatever entity we are as a general partner, and then I go in as Christopher Stout next to Ange and everyone else that's invested. Christopher Stout gets, I'm a third party there. So so my ownership will only show here as what I am as a limited partner. And basically that's it. So just by owning this deal or investing in this deal, I get $5,200 back, which isn't bad. 10% write-off just by being a part of it. Yeah, so that's kind of the power, and you can see the larger numbers you invest. Oh, in this deal, we didn't do cost seg on. So this number would be probably double, if not more than double, if we did cost segregation on. Why are we not doing cost segregation on this deal? We do not plan on owning it forever. The cost seg, and just so you know, the deal you're in, we will do cost seg, so your write-off will be much bigger. So So this is actually considered taxable earnings, just because it is a direct write-off. It's no percentages, nothing. It's straight off the bottom line. Okay, so I know we went off topic. Taxes. I know people are making the big tax push. I know we are. Over the next couple weeks, we're making the big tax push to get everything done. Corporate taxes are due the middle of next month, which isn't any fun. That they give companies one less month to get done than everyone else. Okay, so we'll shoot through what to look for in a multifamily deal. See if I could, and I want to show you something pretty interesting. So we're gonna do a phantom multifamily shop. We're gonna shop for multifamily, and go through what I go through, or Alex will be able to add anything if he sees that he thinks differently of. What do we go through when we look at a deal and we're looking to enter a new market? So this is a screen I wanted to leave up for you, an interesting screen that typically when I search for multifamily, and I don't really use LoopNet, this is something I'll do like once in a great while, probably more now than ever, just for one reason, and I'll tell you what it is. I'll go on multifamily, I'll type in a state that I'm looking for sale, multifamily. So here you would put in property types, multifamily, and usually we'll uncheck dorms, which we're not interested in doing for the most part, we're not interested in doing college. We're not interested in doing college housing, or we're not really mobile home park guys at the moment. So I'll check this off. I'll go to filters. I will put in 100 units minimum. That's typically what we buy, is 100 units minimum, and hit search. The interesting part is North Carolina, which has a tremendous amount of multifamily, does not have 100-unit deal listed on LoopNet right now. That is crazy, that there is not one 100-unit plus deal available in North Carolina right now. And I just found this by accident. I went on quick before I jumped on the Zoom with you guys to go through this with you. And I was like, North Carolina, just so the screen doesn't light up. There's not one for sale. So it is pretty interesting that right now, Alex and I, we're focused on other things other than multi, for reasons just like this. If I clear out North Carolina and get rid of New York, if we clear out North Carolina and New York's loaded with a whole bunch of garbage, and this area is always going to be filled with something, and so will Chicago. So knocking these two off, if you guys have flown or gone anywhere, the amount of buildings that exist in this country, and the screen looks like this when we type in 100 units or better, it is an unbelievable stat that this is the only part of the screen that lights up. Yeah. This screen 6-8 months ago would be significantly redder, if that's a word. So very interesting. I mean, South Carolina, look at this. It's just the amount of, this is a lot of portfolios. So this doesn't even count. This is a portfolio, $5.9 million portfolio, which doesn't count. That's total garbage. So there's literally nothing for sale. So, but this is just, I'm going to show you guys something. Let's pick a deal that looks halfway decent, and I want to show you something that's interesting on LoopNet. It's something that you have to take into consideration when you look. Okay, 257 units in Georgia. Let's take a look at this. So a lot of times, and I never know if this is good practice or not, but I hope it doesn't skew my judgment. I'll go look at a screen like this and I'll say, okay, 257 units for sale in Marietta, Georgia. I scan down to the bottom, and I don't know if a lot of you know that this exists right here. Date created, 4/1/2022. So this deal has been for sale for just under a year. That's screaming a problem, that this deal's been for sale for a year and just past this deal went over the summer. If this deal's been for sale since September, I'm not as concerned, because since September has been a little bit of a shaky time. Or maybe towards the end of the summer and up until now, it's been a little bit of a shaky time. But if this deal's been active since last April, there's a problem, especially with the limited amount of multifamily that's for sale. And like I said, I don't know if this is a good practice or not that I do this, but it skews my judgment one way or another. So what this is going to tell you is there's either an owner who is unreasonable and wants an unreasonable number. That tells you a couple things. It's either that he's waiting for someone stupider than him to come by and buy it cash. And the reason buy it cash is the lenders will not let you, for the most part, the lenders will not let you overpay for an asset. They will limit you for they'll let you buy anything, but they won't let you overpay with the right amount of leverage. So you want to, if you say the right amount of leverage from 65 to 70%, if the lender's letting you put 65 to 70% debt on something, there's a chance that you're kind of paying in the right realm. If a lender comes back and says, hey, we'll give you 50%, 40% on it, don't go searching for lenders that will get you to the point you want to be. Lenders, Alex and I say this all the time, lenders are in the business to loan money. If they're not loaning you the money to do a deal, there's a reason. So if they're looking to only, all right, look at that, under contract. If they're looking to only lend you a very small percentage, then there's a reason why. And they're underwriting the deals. They're looking at deals all day long. And there's a good chance they've probably even seen the deal before you've seen it.
Yep, I echo that, Chris. I think the lenders, more now than ever, they are probably underperforming their goals and origination volume business they had expected. So we're still being very careful who we're speaking to. And, going back to the deal Chris is showing here under contract, what I think we've seen over the last 4 or 5 months and will continue to is the certainty to close on deals. And, previously you saw a deal go under contract. The hit ratio of that coming back on the market was typically lower, just given things were working, rates were low, capital was there to deploy. I think that, as people continue to dig into deals and offer on them and work with the broker, and they see that deal go under contract, it's a more important time now than ever to track the status of that deal. If you see that deal is under contract, I would be following up with that broker consistently over the next 2 to 4 weeks, tracking that sponsor, because that sponsor could typically fall out for 2 reasons. One being their debt moved too much during the due diligence period, the deal does not work anymore, or 2, they're unable to raise equity to close the deal. And brokers, just as lenders are in the business of lending money, brokers are in the business of bringing that deal across the finish line. If a group is to fall out, the best thing they could do is have a ready and active buyer there to lean on. And I think there's going to be a lot of opportunities and a lot of people that transact in that fashion in the coming months. So, although we see under contract here, me and Chris, we don't know this deal, but if we were actively offering on deals, we're going to be in the broker's ear, seeing the status and seeing it through close, just to make sure we're getting the first look if one of those 2 options occurs.
Yeah. So Alex is absolutely right. So these indicators, it's actually, it's an indicator. It's not a reason to switch off and go to another deal. This could mean it's under contract, or it could mean it's just about to fall out of contract. The deal that we're closing tomorrow would have this tag on it at one time, and it wasn't us. It didn't fall out of contract. It was falling out of contract. And before this sticker went away, we got a phone call and the deal was immediately placed back into contract with us. So this sticker would have been off for about 30 seconds and right back on, but it was with a different group and it was us. And it's because we were tracking it, and we probably sensed. You have to become a bit of a, what's the right word? You have to become a bit of a predator, and you have to smell when something's weak. And when you're constantly sniffing around, you could tell when something's weak. we were able to tell that our deal was weak and we didn't stop calling. And inevitably they had no option but to give it to us because their phone wouldn't stop ringing with our voices on the other side. So this is an indicator. It's not a reason to go away. And this is an indicator day created, but it's not a reason to go away. But you do use it in your negotiations, both of them, as you get further into it. And something I'd like to say is when we start looking at these deals, we're like, okay, this deal looks pretty nice. Maybe we want to take a crack at it. What I say in my head, I don't know if I've ever verbalized this, but you want to kind of track this deal down every instance about it, like it's cheating on you. So these guys, Bo Brown, Taylor Brown, Corey Sams, what happens in these programs like Crexy, LoopNet, you click on them, you get a phone number sometimes this could be the office number and you can't really get in touch with them, or send the message. How often does he check his LoopNet messages? Probably not often. The problem when deals get to LoopNet is now it's nationwide. So basically everyone in the country would call him for this deal. This deal, being over 100 units, is now open for outside investment. If a deal is 30, 40 units, you could get someone an outside investor looking at it, but for the most part, deals that are under 100, it's more local people who invest. Deals over 100, it's usually people foreign who invest. Foreign not meaning another country, meaning another state. So 257 unit apartment building for sale, this guy's getting hammered. So this email, this send a message is lit up on his side, and the phone number probably goes to an office. Very rare that these guys would slap their cell phone number on. But it's 2023 and this guy's cheating on you. So you have to figure out where he is. So almost every time, if I'm looking at a deal, I do nothing on this page other than copy and paste his name into Google. If I copy and paste this guy's name into Google, I think you guys could still see my screen here. Bo Brown, I think it was GREA, right? Let's see how long it takes me to get his email address. Come on, bud. Where are you? All right. It usually happens faster than this. Making me look bad, Bo. LinkedIn, not usually there. Not really there. Wow, I'm amazed. Usually I have it by now. Bo Brown. Let's see. Where's your email, Bo? Wow, Bo, you're doing a good job, bud. I think I could find some of the hotshot brokers' email quicker than this guy. All right, give me 30 more seconds. 30 more seconds. All right, let's try LinkedIn. Contact info. Come on, Bo, where are you? Wow, I'm blown away right now. Bo's making me look bad.
Scroll down on his page, Chris. I mean, this is definitely an exception.
Yeah, right? Usually we get this quicker.
I can hear you, Robbie, but you can't hear us, right? No, I can't. Awesome. Good to go.
Let's wet this page. Usually we're able to pull it off the GRE web or whatever.
Who wants page turn? You want me to? Happy to. Anyone have it up? I've got it up.
All right, I bet you it's here. This page just isn't loading. All right, let's go one more person. I mean, they always give you a couple names to contact here. Taylor. Copy. Taylor Brown, GREA. You know, you know what it is? They put their names so many places that you could always get. Alex, you ever see, this, usually these guys' emails are popping right up. You could get it a million different places. All right. GREA is making us look bad. I bet you it's right on their page. And it's just not loading. All right. All right. So after we stalk these guys and we get their personal email, if you give me a few more minutes, I'm not on the spot, I would be able to get it for you. But so we stalk them like they're cheating on us. And then we send them an email. Hey, what's going on with this deal? Make sure you, and one thing is, if you're looking for multifamily deals, make sure you know the lingo. Throw a couple things in there. We're sniffing around for this deal. You know, it's funny. I speak the language so much. It's become part of my language when I email these guys. But Alex, what's some terms that we use constantly? Like the word accretive, is that exists anywhere else than the multifamily or real estate world? Does anyone use that word? What are some other words that we use consistently? Facilitate. Yeah. If you know what I'm going to do, I'm going to put together a little lingo. I have to catch myself when I say them, and I'll write them down because I do catch myself. If you start using some terminologies, it'll actually heighten these guys' senses. Like, all right, we're dealing with someone who kind of knows what they're talking about. Because you understand, if you see apartment buildings like this, 90% of the people that are contacting these guys, like, decided yesterday they want to be apartment owners, and all of a sudden they're looking at 257 unit deals. And a big problem that I see, like, even in, like, I'm a part of some groups and I see a bunch of chatter back and forth. I see people who want to start investing in apartments, and the first deal they bring to the table is $100 million. Like, I saw a guy text me about a deal yesterday, the day before. The deal was $250 million. It was like a deal that Blackstone would take down. And he sent it to me as someone who just started looking at apartments. I'm like, dude, get that off your screen. You'll never put yourself in front of it. So, okay. So, all right. So say we got in touch with Bo or Taylor, and I've actually spoken to Bo in the past. I'm surprised I can't get his email. I'm going to look up the town again. I want to know everything about it. I want to know everything about this town.
Chris, you were right. His email address was on that page. That wasn't loading for you.
Ah, thanks, Ange. Made me look a little bit better. Oh, yeah. So if you're looking, you'll be able to get his email. It was right on the company, GREA's company website. So you'll be able to email that guy directly, and you could skip his LinkedIn, not LinkedIn, LoopNet messages that he probably checks once a week. And he may not even check it. He might have an assistant check it. Okay, here's another small thing I've noticed. This is just internet wide. You get so much better information on Google. They just own the space. All right, so I don't know anything about Marietta, Georgia, right? Where is it? So the first thing I do, I go to Marietta, Georgia, maps, or something I should do more specifically. What I'm going to do more specifically is I'm going to put the property address in. And sometimes they don't give you the address. You just look up the name again. You have to stalk these deals. Stalk them and you find out everything about them. Sometimes I know Alex and I, we don't have an address, but we have a map, a point on a map. We'll look at the highways in the area, see where they intersect, and keep zooming in until we find that roof. Perfect. Maps. Okay, so I don't know anything about this market, right? Let me make you guys smaller so I can play around here a little bit. Satellite. First thing I want to see is density. So I'm looking around this area. I want to see how much green do I see? How much dirt do I see? An area like this, I'm going to guess a lot of this is just FAR absorbed. It could be FAR absorbed or landlocked property. So you'll see in an area like this, and let's see where it is on the grand scheme of this whole thing. Okay, it's basically Northwest Atlanta. So we know Atlanta, being its most solid in the center, grows out. As you get further away, then you start seeing some dirt, right? So I want to see what's the closest that I'm able to see dirt. Sometimes you look at a deal, there'll be a deal right here. There'll be a real estate, there'll be a multifamily, whatever we're looking at, it'll be right here. And then all around here will be all fields. So the first thing I do is I zoom in, I look, and I'll just look at the property quick. And remember, while you're looking, and there's ways to see this, but looking around, you don't know immediately how old this Google image is, or the Google map is, or the Google Earth is. So, but I want to look quickly. I want to see what kind of shape is this deal in from the sky, and how much differently does it look in the street compared to what they show on the OM. So that'll be able to tell me if it's quickly been traded, if it's been traded, or sometimes you can't get a camera in there. Yeah. So we want to know if this thing's been traded recently. Sometimes you'll look at it and you're like, oh my gosh, it looks so terrible in the Google Street View, which means that they literally flipped it 10 minutes ago, and they're looking to just make a quick flip. So when you're looking at multifamilies and you're getting involved with a quick flip, so owned for a year and a half, there's a lot of times it's much more difficult to squeeze value out of those deals because the guys who own it currently are there to literally squeeze the deal as much as they possibly can. When you buy it from a family or an asset that's been owned for a little bit longer period of time, you're in a better spot to, let's see if we can get it here. No, we're not getting it. Yeah, the street view is off. They never went in. Oh, you can see it highlight. It doesn't highlight inside, so we can't see what it looks like. But basically, we want to do is we want to drive around this town like we own it. So I'll do something like this. I'll look at this, and then what's another big driver for us? So we don't know the area, but Starbucks does. Where's the closest Starbucks? All right, we got a little bit. There's not that much of a distance here, but it's not concentrated. We're kind of in the middle of all these Starbucks. This is actually not a terrible distance to a Starbucks. Oh, and then we have Chick-fil-A. So basically what we're going to do next is, so we don't have a tremendous amount of dirt surrounding us. So when you have a tremendous amount of dirt surrounding you, that means that people will continue to build. We're right here. People will continue to build, and that will keep rental prices flat because now you're going to be in constant competition with the next new guy. When there's not that much space to build, now you're contending with convenience. So there would basically have to be a new master plan development to compete with you. So if we zoom out and we see a whole bunch of dirt, the next competition, if you're looking at something with a ton of dirt around, the next competition would be the new master plan, which would include development of multifamily, retail, and the whole town would be developed. But here we're in the center of a bunch of Starbucks. I don't dislike this. I don't dislike this clutter of Starbucks so close by. That's very nice.
Yeah, I agree with that, Chris. And I would say to your point with density that you spoke on earlier, access to schools is very important. And that reflects how much demand actually is there today. And typically, if you see a large amount of schools or larger schools that you can then go online, look at the enrollment, it's telling to see how the county and state looks at that general market.
Yeah, the schools and rentals are, I mean, if you think schools are big in home ownership, they're even bigger in rentals.
Yep.
And that's, rent doesn't, Alex and I were in Dallas last week. Seems like forever ago. We were in Dallas last week. And rent doesn't really fluctuate from town to town as much as it does home prices. So what we're trying to do with the build to rent, I shouldn't say try. Try is a curse word for everyone that's here. Just so you know, try is a complete curse word. We don't try, we do. So the build to rent that we're doing, we're finding the good balance between home price and rental price. So really what's going to happen is the best rated school areas, being that they're not much more expensive from a rental standpoint, will rent faster. So if you go to a worse school district and you'll say, oh, these apartments are renting for $1.40, $1.50 a square foot, and the same thing in another area, the school's better, the area that the school isn't as good, there will just be more on the market, but the rental price will kind of stay the same. They will eventually get absorbed, but the vacancy rate on those units will definitely be higher than something next to a better school. Something that we were looking at, let's see if there's any value to showing you. And just know that towns grow weird. So this is kind of, what do we look for when we're looking in a new market? Towns grow in a really weird position. So this is Dallas. What we could tell you by visiting Dallas, that this is obviously city center. There's a lot of really high income right in this area. And then Dallas gets pretty bad close by. And then it gets good again. So if you're not, you don't have to just relate yourself, say, okay, the closest we get to city center, whether it be Dallas or Fort Worth or Arlington, means that you're going to get the best neighborhood. So you have to constantly be looking in certain areas and see something like this. And this is just, I'm just bringing up like things that my eyes go to. I saw Fiesta Mart, I zoom right in. And I don't know if this is PC or not, but I see something like that. I'm like, all right, this area is probably a little bit weaker. Probation office. Okay, so a probation office, you got a little bit weaker of an area. So we got the middle of Fort Worth, we have an area with a bunch of houses with a bunch of dirt. People aren't building. That usually means that the land isn't worth the grass that it's printed on. I just came up with that now. But we've seen a lot of land that it doesn't matter if you got it for free, it wouldn't be worth building on. From the sky, you zoom around. This is all stuff I do when I look for a new market. Look at this. I just zoom in from the sky and I could tell that this is not the best part of town. There's something about bad parts of town and people treating their houses like junkyards. This happens nationwide. I'm not kidding you. Like, oh, we're looking at a multi. Look around the block. Junkyard. We're not buying here. And all I have to do is zoom, let's say, just to look a little bit closer to Fort Worth. I bet I just zoom, let's pick another random area. Okay, so now we see a whole bunch of different color roofs, very close next to each other. We know this area's been around for a while. I'm just picking out random stuff that I'll be looking for. Oh, what's this? Country Club? They're not building typically. I always like to say typically because you'll find exceptions to anything I say. Country Club, usually surrounded by nicer areas. And people say, where do you get your comps? Where you go to CoStar, this and that? I'll tell you the truth, we spend a lot of time on Zillow. Why? Because typically when we're buying something, we want to act as a consumer. So the next thing that we'll do is we'll go, there's my K1, we'll get rid of this. So I went on Google Maps, that's the next thing I do. The first thing I do is the first thing I do is I email the broker. Next thing I do is I go on Google Maps. The next thing I do is I'll do Zillow.
Yeah, I completely agree with the Zillow comment, Chris. I think it's become more important now than ever, given there's a lot of leases, a lot of homes that are marketed on the Zillow platform. To understand what a consumer, renter, family can rent a home for in the area is very important to understand if what you're underwriting should be at a discount to that, as well as what concessions could possibly be being offered in the market.
Yeah, so we'll see here. So this is the unit. What you're going to see when you download the OM, that's the offering memorandum, what you're going to see is you're going to see rent comps that they lay out for you. So what you do on Zillow, very simply, you zoom out a little bit. Usually this is what my screen looks like. There's no science to this. You go a couple mile radius and you could quickly tell what is renting for what. So we have a 3-bedroom, 2-bath renting for $2,200, 3-bedroom, 2-bath, $1,800. You quickly pull it up. What the heck is the difference between the two? All right, so say a moderately renovated house, $1,800. We want to see how long this one's been on the market, 18 days listed, not a terrible amount of time. So here, quickly, quick math, we're renting for just about $1 a foot. You're going to see the whole, not the whole country. There's a large majority of the country that's renting for $1 a foot or just about $1.05 a foot, whatever that math is. Again, at this point, not totally imperative to get to the penny. When you go to buy the deal, you're going to get even tighter. Okay, so this one's more, but it's significantly larger. $2,800 for $2,200. This is under $1 a foot. Listed for 121 days. Okay, we have to look further into this. 2,100, 1,900 feet, closer to the $1 a foot, a little bit more than $1 a foot. What's going on here? 3-bedroom, 2-bath. Okay, but we're starting to get a feel. We've never been to this area. We don't know what's going on there. Marietta, Georgia. I do not know. Me personally, Chris Stout, I have no idea what goes on in this area. Never been there. But I'm starting to get a feel. I'm starting to get a feel for the market. What's for rent? Townhouse, $2,000, 1,400 feet, 3-bed, 2-bath. So we're starting to see a trend here. They're not getting the credit for the square footage in this neighborhood. People don't care about the large square footage. They care about the bedrooms. That's something super important to look at. This is a feel that I'm getting. I'm just speaking my thoughts as I'm going through the market. This guy's not getting any credit for his house being 2,800 feet. This guy's getting much better pound for pound, dollar to pound. Alice, what is it? Dollar to pound, pound for dollar?
Price per pound.
Price per pound. That's right. So basically the people that are, this guy's getting a lot of price per pound, 1,300 feet, 2-bed, 3-bath, $1,700. So the smaller are actually getting better price per pound than the guys who have the bigger apartments or houses marketed.
Yeah.
And this is actually, go ahead.
No, Chris, you're exactly right. And I think what speaks to that is with the increase in building costs, everyone wants to read about lumber going up, your Home Depot bill going up. Builders are continuously being inclined to build smaller units to keep their costs low. So I think bigger units in today's market as is are attractive, but you need to make sure you're getting that dollar for dollar increase.
Yeah, which in a lot of markets, it doesn't. So you're going to see future home development. Homes are going to be smaller. Homes are definitely going to be getting smaller in the future. In the market, say South Dallas, where Alex and I were looking at, if we were to build a 1,400 or 1,500 square foot house versus a 18 or 19 or 2,000 square foot house, we're not getting any more money. It's basically remaining flat with a very, very small increase. But the bedroom count makes a huge difference. So from a 2-bedroom to a 3-bedroom and a 3-bedroom to a 4-bedroom, you're getting paid more, but you're not getting paid more for dollar in your square footage, which really you're paying per square foot to build it. So new product will continuously get smaller just for this exact trend. So this is basically what I do when I'm looking at a market. And then one last thing that I'll probably do third is I'll just go on Google. Alex is actually very good at this. He does this quicker than I do. He'll go on Google, put an address in, or actually He'll put an address in. He'll search the actual address to see if there's any news on that address. Okay, so the only news on this is someone who bought it. Oh, look at this. Fillmore Capital Partners grows Georgia footprint, January 28, 2021. So they had a press release when it went out. And like I told you, you have to treat these deals. I don't know, should I be accepting or rejecting cookies? I always accept, and I don't know if that's good or bad. Who doesn't want a cookie? So Fillmore Capital Partners grows Georgia footprint. Let's see, purchased a 257 unit, partially affordable community. And what we're looking for here is, let's see if, oh, look at this. Alex, this probably means that there's floating rate debt on this deal, right?
I would say so.
Yeah, so these are things that we just know through experience. The bank corp, there's a good chance that there's a period of time, a certain period of time, these guys bought this thing about 2 years ago. There's a loan expiring on this soon that they did not expect to hit. They did not expect to hit interest rates of where they are.
Okay, should we get it?
What's that?
Should we get it?
Yeah. Well, it's on the contract. Hey, Alex, email these guys after we get off the call. So, so this is just stuff we'll do. We're actually looking for, like, we're not. I wasn't even looking for this, but I wasn't looking for this. But this is something. So basically, what we're looking for, what I have my eyes for open in this press release is, what were their plans when they bought it? Was there an intention to keep it? Was there an intention to get rid of it? And the interesting part about the internet is, you put it on the internet at January 28th, and that shit is on the internet for as long as you would not like it to be. So if they had an intention to keep this thing and all of a sudden it's for sale, that's interesting. So you search for news on the exact property, and then something next that we'll do, I use copy and paste a lot. We'll search for some news on the area. And all this probably happens in about 10 minutes, right, Alex? 10, 15 minutes, we're done through this initial viewing. But mind you, I did not underwrite this deal yet. I did not look at the numbers yet. Oh, sorry, what did I just do? This was an accident. What did I click on? Scene is now safe. Bomb threat. Oh, all right, nice. So we did not look at the numbers yet. I'm just looking, do I get into a new town? News, okay, bomb threat. Bomb threat could happen. Bomb threats happen. And something that I do here is I'll go to population. People moving to an area will let you know if the area is any good. Typically, people do not move to bad areas. They move to good areas. And if bad areas are getting good, they move there. If good areas are getting bad, they're moving away. So there's usually two places to look up. Google gives you a few from the United States Census Bureau and World Population Review, which is usually when you type in whatever town population, it seems to give a little bit more of an enhanced view. Sorry, I'm loaded up with ads here. It's probably because I take in cookies. Let me get rid of this. Pulte Homes, huge. So World Population Review, you can see this is actually similar to the Google. There was a drop here on Google and then it went up. You could compare it. Yeah, there's that drop and then it continued to go up. So I'm not sure who's more on point. The World Population Review seems to use the census as well. So we kind of take somewhere in the middle, and then you could actually go to the census website and see what they're saying about the area. And then you could you just get really into the nitty gritty of who is doing what, what's the demographic there. and just go on and on information. And this is all stuff that I'll probably look at this screen at this exact rate. I'll probably scan this quick. I'll stop along the way, look at a couple things, and I'm on my way. If all this checks out, I will then underwrite it. I will not underwrite a deal until I do this quick view, which in reality, I slowed down for you guys, probably takes me, I don't know, 7, 8, 9, 10 minutes. Like 10 minutes was a long look. Because 10 minutes, remember, I went 10 minutes because everything that I saw let me go to the next stop. So if I don't see something I like, I stop and I'll go do something else. So if I made it the full 10 minutes, then that means that I like what I'm seeing. All right. I think that's a good overview of what I do. Alex, if you have anything to add of what you do, Alex usually finds like deeper dirt than I do when looking at deals. You still there, buddy? You jumped off. He probably walked away. All right. Everyone have any questions or anything? I know there was some stuff going on in the chat. Thanks, Tom. Always appreciate you being here. Tom Pierce, the guy who didn't hire me, but then we talk all the time. It's all right, Tom. I'll never forgive you for it. I was supposed to build Tom's custom house, which came out awesome. I can't even hate on it. Really, Carpenters Touch did an amazing job. But we remain friends. There's a bunch of people who I've met through custom home building for one reason or another. They didn't hire me, and then we continue to be friends. Because you know what? If you don't hire me, don't worry, I will not be bored. You do not have to duck my calls. Okay. So if
Wait,
anyone
Chris.
has any questions, what's that?
Yeah, so you email the broker and you just tell them you're interested in that property and you use your hotel. And then you go to Google Maps and check out the area. You don't want to check it out before you email them, because what if you check it out and you're like, ah, forget it?
You know, that's a good question of when we email the broker. A lot of times the email to the broker is kind of just dipping your toe in the water. And remember, so this whole thing is broker relationships, right? So the broker may come back and say something, whatever he says. And so now you started a dialogue with the broker and say, hey, we look deeper into this deal and we realize it's not for us. The reason that I jump right to the broker email is if I email him and then I get on with it and I look at it, and by the end of my couple minute search, I'm like, man, this deal's not for us. I already started a dialogue with the broker. And now when I learn that I don't like the deal, I could tell the broker that when he finally does answer me, which sometimes happens quickly. It usually happens within 24 hours. These guys usually get back to you, especially now they're getting back to you. There's nothing going on. You could say, hey, this one's not for us. What else you got? And then you introduce yourself. Hey, I'm Chris Stout. We buy over 100 units in the Southeast. We like this market, this market, this market. We've been trying to get into your market for a while. Or we own already in this market. We have this many units. Maybe you heard of us. Maybe you know of our group. What else do you have? And now that's starting a dialogue with the broker to potentially get into a deal that is, hey, like we hear this stuff all the time. Hey, okay, no problem. You don't like that deal. This deal just hit the office and it's about to let go. We're starting to let it go now. And you're like, oh, all right, here's a deal that wasn't on LoopNet. Because remember, we found that deal on, we just, as a group, thanks for being along with us, found this deal on LoopNet. That means that this thing is to die. But these guys do sell good deals eventually. One day they'll Bo Brown, Taylor Brown, and Corey will have a deal. So just because their deal, just because they don't have all their deals listed on LoopNet doesn't mean they don't have more deals. Right. So if you say, hey, we like, you know, the Pines at West Cobb was cool, but we only buy 100 to 120 unit deals. What else you have? So you just got that dialogue started. And really, as you pick up a little bit of speed, now you have a website. Now people know you. Another thing, I was on a podcast earlier today, And I brought up a point, and I was on a podcast with a company called Leverage Companies. Leverage Companies, I think that's the name of their company, is Leverage Companies. They're real estate guys in New Jersey, and they were asking me a bunch of questions. We had a great time on the podcast. Of course, one of the busiest days I could have today and tomorrow. I was like, yeah, sure, I'll be on a podcast. I'll take an hour out of my absolute busiest day, which we kept it short and quick, which was nice. A point that I didn't realize how powerful it was until I said it verbally is, if we're looking at a deal now, so we get a lot of our money through CBRE. They're our debt broker. And what's proved to be very powerful is, one of the biggest problems in these large multifamily deals is the brokers are nervous of giving the deal to someone who can't close the deal. So now, especially if we're looking at a deal from CBRE, and we could still do this with other brokers, we'll say, hey, we have our broker on this email. Tom, our broker from CBRE, is on this email. Now, Tom from CBRE, which is obviously no bullshit shop, will interject his opinion about us, and he will speak to what we've done, which becomes very powerful, because they're like, okay, these guys, it's not their first apartment deal. They have their broker from CBRE who's taking time out of his day to talk on a deal that they don't have yet. They must be somebody. So a goal here of us is all try to be somebody that someone else is willing to put their name on the line for. And once you build up that momentum, now these deals start coming, not extremely easy, it's still very difficult, but it becomes a little bit easier. Then now they know they're talking to someone who could actually get something done. So this is why the broker relationship, you have to start as many as you could. And now you're talking to Bo, and this is why we do that first. That was a long-winded answer of.
Yeah, no, that's okay. That was going to be my next question, is why email instead of just pick up the phone and call them? But you're kind of giving them a lot more information about yourself when you email them.
Yeah, and I'll tell you the truth, and I don't know about you, Ange, but me personally, I'm far happier, and not you, of course. You could call or text me at any time. You could call me at any time, but I'm far happier when someone emails or texts me.
Yeah.
Just because I'm so conscious of every moment of my day, like every second has to be used to its fullest potential, that sometimes calls take too long.
Yeah.
And sometimes a call, I'm in the middle of like I'm in the middle of the Zoom right now. My phone probably rang 3 times. They didn't get me. And if I call them back and they missed that call, we're done. But if they send me a text, I'll be able to answer that text when I get around to it.
Yeah.
And same thing with emails. So if you call the guy and he doesn't pick up, so I'm not talking badly. If you want to do both, that's not bad either.
Yeah.
But you could actually, sometimes with an email, you could, because this business, listen, you have to fake it before you make it here. And sometimes you can fake it a little bit better on an email.
Okay.
Usually.
But you don't have to fake it. Like you are somebody.
Oh, thank you. Yeah. So again, but as we all have to start somewhere. So, the track record and the people who speak for us is excellent, but when you're starting, you got to do everything you could to get going. So if a phone call works, by all means. A lot of times, if they have a phone number here on LinkedIn, I keep calling LinkedIn LoopNet. This is probably an office number. And being that there's one number below the rest of them, this is, because they can't have everyone in the nation who's interested in investing in an apartment building call them.
Yeah.
It just wouldn't be a good use of their time. But again, hunt them down like they cheated on you, and you can find their cell phone, because at one time somewhere they did drop it on the internet somewhere, and it's there, and we'll find it.
Hey, Chris.
Yo, Connor, what's up, bud?
How are you?
Good, man.
Hey, I wanted to just mention, I've gotten way more into calling these guys, and I tend to get a lot more information they wouldn't say in an email over the phone. What are your thoughts on that?
You saying they would say more in an email than they would on the phone?
Yeah, they'll disclose a little bit more information, maybe something about the sellers, kind of what they're actually looking for. Whereas I've texted a few guys lately, and you ask them how long they've been on the market, pricing, this, that, and the other, and they try to steer clear of it because they're not, directly answering you face to face.
Yeah, and I think again, when someone's on the phone, all they're trying to do is get off. So when you're on a phone, I mean, a lot of these guys are on a phone call, all they're trying to do is get off the phone. And a lot of times, how about this? If you call Bo and you're like, Bo, talk to me about Pines at West Cobb. He's like, I don't know. It's 257 units. Who are you? A lot of times they have an email prepared for this. So if you email them, they copy and paste the email for this address in a response. And you could tell, it'll say like, hey, Connor, comma, and then this long email that has all the details of the email in it. So it's a pre-prepared email set out. So you'll get a lot of the information in that pre-prepared email because they spent a lot of time on that pre-prepared email. And it'll give you most of the information and they just shovel it. And now you get more than if you would have called the guy trying to drag all the information out of him. And by the way, Connor, thanks for joining. Connor is we met indirectly. Connor's a broker in the Alabama and Atlanta, Georgia area. Connor,
Yep.
Do you know of this deal?
I have seen that deal. I believe it's been on the market for half a year now.
Oh, well, yeah, I saw you join on the call after we started. I'm not breaking your chops.
Oh, you're good.
But that's actually what we spoke about.
Oh, sweet.
Yeah, it's been on the market.
That looks familiar. I think it's been sitting quite a bit.
Yeah. And see, this world, let me tell you something. And a reason that you have to do great things in this business is this world, as big as this country is, and you fly and visit any town, and there's all these multifamilies that exist. This world is so small that Connor joined the call after we started. Him and I could jump on the phone and I could mention something. He's like, oh yeah, the Pines at West Cobb deal. So we're talking about a deal in Georgia. I live in New York. He bounces back and forth between Alabama and Georgia, and we both know the same deal. If I mentioned a 2-family in Staten Island or a 2-family or small deal around here, the only people would know about it is a select few people in the surrounding blocks. This multifamily world is so small, yet it's so big, yet so small, that if you start getting involved in deals and you do not close them, you will quickly earn the name of someone who's unable to get deals done. So once you pick up a little bit of speed and you get this name of people know who you are, you don't need an introduction, the much more likely you are to win deals. So my advice to really anyone is start. What do you buy? Just start. You will fall into something that makes sense, and do not fight it when the lenders say, this deal's no good, or sure, we'll give you 40%, we'll give you 50%. We'll only give you 60%, and that's pushing it. Those should be alarms. The lenders will stop you from making a mistake, and that's because they are the biggest investor in your deal. If you hear Aetna is writing 65%, which is their max on a deal, that's a hotshot lender who's saying, we'll give you all the money you want for this deal. Okay, now we're talking. So that's, I think that's all I have to say about that. If anyone had anything else, we could add it. If not, we'll see you on Monday, next Monday.
Thanks, Chris.
Thanks, Ange. Thanks for coming as usual. All you guys who repetitively come, we love you, and we'll see you next week.
Awesome.
Yeah.
See ya.
See you.